A single conversation changed everything I thought I understood about silver. Not a price alert, not a market prediction, something far more significant. What I discovered reveals a transformation happening right now that most investors are completely missing. And if you're not paying attention, you might find yourself on the wrong side of history's biggest wealth transfer. Stay with me, because what I'm about to share will challenge everything you believe about precious metals investing. Welcome to Money Aftermath, where we cut through the noise and focus on what actually builds lasting wealth. I'm here to have real conversations about money, investments, and financial security in a world that seems increasingly uncertain. Before we go any further, do me a quick favor. Hit that subscribe button right now. Seriously, pause and click it. Why? Because the information we share here isn't the typical hype you'll find everywhere else. We dig deeper. We think differently. And if you're serious about protecting your financial future, you need to be part of this community. While you're at it, drop a comment below and tell me where you're watching from. Are you in New York, California, Texas, or somewhere else entirely? I genuinely want to know, because what's unfolding in the silver market right now affects people globally, and your perspective matters. Now let me tell you about this conversation that stopped me in my tracks. A bullion dealer, someone who's been in this business for decades, called me with urgency in his voice. He wasn't talking about charts. He wasn't discussing technical indicators or resistance levels. He was talking about people, real people. And what he told me revealed something that's been decades in the making, something that is quietly reshaping who controls physical silver and who's going to be left scrambling when supply becomes truly scarce. Picture this scene. It's an ordinary Tuesday morning at a precious metals dealership. The dealer sits down with his morning coffee, opens his computer, and starts reviewing the previous day's orders. At first glance, it looks like business as usual. Orders came in, transactions processed, inventory moved. But then something catches his eye. He starts scrolling through the list more carefully. New customer, another new customer, first-time purchase, small order, another new account. 20 ounces here, 15 ounces there, 50 ounces from someone stretching their budget. He leans back in his chair, and that's when it hits him. The names keep coming, but they're not the names he's used to seeing. These aren't the institutional players placing massive orders. These aren't the wealthy collectors buying by the hundreds or thousands of ounces. These are everyday people, teachers, nurses, small business owners, retirees. People who've never owned an ounce of silver in their lives are suddenly buying. The dealer picks up his phone and makes a call. He needs to share what he's seeing, because this isn't just another busy week. This is different, fundamentally different. And anyone who understands markets knows that when buyer behavior changes, everything changes. Sure, silver prices surged past $80 an ounce in early 2025. The headlines screamed about record highs. Financial news channels couldn't stop talking about it. Traders celebrated. Analysts debated whether it would hit 100. But beneath all that surface-level excitement, beneath the price movements that everyone was obsessing over, something far more significant was taking place. A demographic revolution. A transformation in who's buying physical silver, and more importantly, why they're buying it. The dealer had witnessed bull markets before. He'd seen silver spike during the financial crisis. He watched it surge and crash and surge again over the years. He understood market cycles, but this time felt different. This wasn't just price-driven speculation. This was something deeper, something more sustainable, something that suggested we're at the beginning of a major shift, not the end of a temporary rally. He reached out to colleagues across the industry to see if they were experiencing the same phenomenon, and they were. Summit Metals, another major dealer, reported their order systems were being flooded with new registrations daily. Their customer service teams couldn't remember the last time they'd processed so many first-time buyer accounts. One dealer told me it's not the size of the individual orders that's remarkable, it's the sheer volume of new people entering the market. And that's when the bigger picture started coming into focus. Let me pause here and make sure you're still with me, because we're about to dive into why this matters more than any price prediction you've ever heard. If you're finding value in this conversation, show some love by hitting that like button. It helps more people discover this content. And I want you to share this video with someone who needs to hear this message. Your friend who's worried about inflation. Your family member who's concerned about their retirement savings. Anyone who's paying attention to what's happening in our economy right now needs to understand what's unfolding in the silver market. Drop a comment too and tell me, do you currently own any physical silver? I read every single comment, and your insights help shape the content we create here. Now, here's what most people completely misunderstand about the silver market. They think it's all one big pool where everyone's playing the same game, but that's not how it works at all. The silver market is actually divided into very different segments with very different players who have completely different motivations. On one side, you have what we call the paper silver market. These are exchange-traded funds that track silver prices. Futures contracts traded on commodities exchanges, mining stocks that give you exposure to silver's price movements. These instruments are fast, they're liquid, They're convenient. You can buy and sell with the click of a button. But here's the critical thing to understand. They're not physical. You don't actually own any silver. You own a financial instrument that's tied to silver's price, but you'll never hold it in your hands. You'll never store it in your safe. It exists only on a screen as numbers in an account. On the other side, you have physical silver holders, real coins, real bars, real rounds that you can touch, weigh, and store. This segment represents roughly 25% of the entire silver market. Only 1/4. But here's what the financial establishment doesn't want you to fully grasp. The 25% holds disproportionate power over the entire market. Think about it this way. When one billionaire decides to buy 10,000 ounces of silver, sure, the market notices. The price might tick up a bit. Social media buzzes for a day. Then things go back to normal. But when 10,000 individual people each buy 10 ounces, something entirely different happens. That silver gets distributed, spread out across the country, tucked away in home safes, security deposit boxes, closets, drawers. And here's the key point. It doesn't come back to the market easily. It doesn't get sold on a whim because someone needs quick cash or because the price dropped 5%. That silver gets removed from circulation. And when enough people do this simultaneously, when enough silver gets pulled into what we call strong hands, hands that plan to hold for years or even decades, the available supply actually shrinks. Not on paper, where you can create infinite contracts. Not in theory, where analysts write reports. In physical reality. The dealer I spoke with understood this instinctively because he's been in the precious metals business long enough to recognize patterns. He knows that the real power in this market doesn't come from the biggest buyers. It comes from the most distributed ownership. When silver is concentrated in just a few hands, those hands can be shaken loose. A price drop happens. Panic sets in. Liquidation follows. But when silver is spread across thousands upon thousands of small holders, people who bought for protection rather than speculation, people who bought for insurance rather than quick profits, those hands don't shake easily. And that's exactly what he started witnessing throughout 2025. A new generation of silver stackers was emerging. These weren't people glued to their screens watching minute-by-minute price fluctuations. These weren't day traders trying to flip positions for fast money. These were people buying and planning to hold, period. The bull market had done something the dealer hadn't fully anticipated. It didn't just push prices to record levels. It awakened something that had been dormant in the American psyche. A recognition that maybe, just maybe, the traditional financial system isn't as rock solid as we've been told, that maybe holding something tangible, something real, something that can't be printed into existence or digitized or manipulated with keystrokes, actually makes sense in today's world. But with this awakening comes a massive responsibility. These new buyers entering the silver market need education, real education, not hype, not promises of getting rich quick. They need to understand exactly what they're getting into because silver is not stocks. It's not cryptocurrency. It's not a lottery ticket with guaranteed payouts. Silver is volatile, brutally volatile. It can drop 40% in a matter of months. It can trade sideways for years, testing your patience and your conviction. It can make you question whether you made the right decision. And if these new stackers don't understand that reality up front, if they bought at the peak of excitement without proper knowledge and without realistic expectations, they'll become the next wave of panic sellers when prices inevitably correct. The dealer knows this pattern. He's seen it play out before, and that's why his phone call mattered so much. Because the real news about silver in 2025 wasn't the price surge. It was the people entering the market. But only if they stay, only if they understand what they own, only if they're prepared for what comes next. There's a fundamental truth about markets that most investors never truly learn. Price movements tell you what already happened. They're backward-looking. But buyer behavior, that tells you what's coming. And right now, the behavior patterns are absolutely screaming. Let me paint you a picture. Imagine two completely different rooms. In the first room, you have a professional trader sitting in front of multiple computer monitors. Charts everywhere. Numbers constantly updating. With a few clicks, he can own exposure to 10,000 ounces of silver instantly. No physical storage concerns, no security issues, no delivery logistics, just pure price exposure. A position on a screen, and he can exit just as quickly as he entered. One click to buy, one click to sell. This is the paper silver world. Fast, efficient, convenient. Now imagine a second room, a different kind of buyer altogether. She opens a package that just arrived. Inside are 20 American silver eagles. She picks one up, feels the weight of it in her hand, examines the detail on the coin, reads the inscription. Then she carefully places each coin into her safe. She doesn't check the silver price every hour. She doesn't plan to sell next month or even next year, maybe not for decades. This silver isn't a trade she's trying to time. It's insurance. Insurance against inflation eating away her savings. Insurance against currency collapse. Insurance against all the unknowns that keep her awake at night worrying about her family's financial future. These two rooms represent two completely different philosophies towards silver. The first room operates on leverage, speed, and efficiency. The goal is simple: profit, capitalize on price movements, extract gains, move on to the next trade. The second room operates on something else entirely: permanence. The goal isn't to make profits that you can brag about on social media. The goal is preservation, protecting what you've worked your entire life to build. And here's what most market analysts completely miss when they're discussing silver. The second room is where the real power lives, because silver in that first room, the paper silver, can vanish with a keystroke. A margin call comes in. A fund decides to rebalance. A large institution liquidates. That silver flows right back into the market instantly. But silver in the second room, it's gone, removed from active circulation, locked away in private hands. And when thousands of people, then tens of thousands, then hundreds of thousands all do this at the same time, something extraordinary starts happening. The available supply contracts, not on paper where you can create more contracts out of thin air, not in theory where economists write research papers, in actual reality. Meanwhile, industrial users still need silver for manufacturing. Technology companies still require it for electronics, solar panels, medical equipment, but now there's less physical silver available to meet that demand because a growing percentage sits in safes in homes and private vaults, held by people who have absolutely no intention of selling at any price in the near future. This is what the bullion dealer recognized. This shift from room 1 to room 2, from traders to holders, from speculators to preservers. The 2025 bull market didn't just create trading profits for some people, it created converts, people who started asking uncomfortable questions they'd never seriously considered before. Questions about their savings sitting in banks, questions about their retirement accounts heavily weighted in stocks, questions about the stability of the banking system itself, questions about what money actually means when governments can print unlimited amounts of it. Consider what the Federal Reserve openly states as their policy target: 2% inflation every year. Forever. They don't call it theft of your purchasing power, they call it price stability. But do the math with me for a second. 2% annual inflation compounding over time means that in just 36 years, your currency loses half its purchasing power. Half. Everything you saved, everything you worked for, cut in half in terms of what it can actually buy. That's not stability, that's managed decline. That's accepted debasement. That's wealth erosion by deliberate design. And the people moving into room 2, the physical silver holders, they're rejecting that design. They're saying something simple but profound. I want out. Not out of the economy. Not out of participating in society. Just out of a system where printing presses run endlessly. Where rules change whenever it's convenient for those in power. Where your savings get quietly stolen through inflation while you're told it's for your own good. Silver offers an alternative. Not a perfect one. Not an easy one, not one without its own risks and volatility, but an alternative nonetheless. The woman with those 20 silver coins in her safe understands this instinctively. She doesn't need a PhD in economics. She's not following complex monetary theory or reading central bank policy papers. She simply knows that those 20 coins will still be 20 coins 10 years from now, 20 years from now, 50 years from now. The number doesn't change. The weight doesn't diminish. The silver doesn't evaporate or get diluted. While everything around her inflates, dilutes, and devalues year after year, her silver remains constant. But this strategy, this approach to silver, requires something most traders completely lack: patience. Silver's price is volatile in ways that can test even experienced investors. It can surge 40% in a few months, creating euphoria. Then it can collapse 30% in a matter of weeks, creating despair. It can trade sideways for literal years, testing your conviction, challenging your resolve, breaking weak hands who lose faith. The new stackers entering the market throughout 2025 need to understand this reality before they put a single dollar into silver, because if they don't, if they buy silver expecting smooth appreciation, linear gains, and predictable returns like they might get from a savings account, they will panic. They'll sell at exactly the worst possible moment. They'll reinforce every negative stereotype about retail investors being the dumb money. The dealer's concern was completely legitimate. He'd witnessed this pattern play out in previous cycles. New buyers flood into the market during bull runs. Excitement is high. Expectations are even higher. Then reality hits. Prices drop. The financial media turns negative. Fear spreads like wildfire. And those same excited buyers become panicked sellers, providing liquidity and profits to the smart money. But something felt genuinely different this time around. The conversations the dealer was having with customers, the specific questions people were asking, suggested a different underlying motivation. These weren't 20-somethings trying to day trade their way to quick riches. These weren't speculators chasing momentum. These were teachers thinking about their retirement, nurses worried about healthcare costs, Small business owners concerned about their children's future. Retirees who'd watched their savings get crushed in 2008 and were determined not to let it happen again. They weren't asking, when should I sell to maximize profits? They were asking fundamentally different questions. How much silver should I realistically hold? Where's the safest place to store it? What form of silver makes the most sense for long-term holding? These questions revealed something critically important: a long-term mindset, an insurance mentality, a preservation strategy rather than a speculation strategy. And that's when the bigger picture crystallized in the dealer's mind. The silver market was undergoing a philosophical transformation, from speculation to security, from trading to holding, from paper promises to physical possession. Remember that 25% figure? 25% of the silver market exists in physical form. Coins, rounds, bars you can actually touch. That percentage might sound small, but it represents the foundation, the anchor, the reality check for all the paper contracts traded above it. And as more and more people move into that 25%, as more silver gets pulled into strong hands with no intention of letting go, the fundamental dynamics change, not overnight, not in an obvious way that shows up on a chart, but fundamentally and permanently. Because here's something you absolutely must understand. You can print contracts. Financial institutions can create ETF shares. Exchanges can leverage futures positions. But you cannot print physical silver. You cannot create metal from thin air, no matter how much demand exists. The supply is genuinely finite. Mining production is capped by geology and economics. Above-ground inventory is measurable and limited. And when that inventory starts disappearing into private hands, hands that don't plan to release it back into the market, the scarcity becomes real. Not theoretical, real. The woman in room 2 with her coins doesn't consciously think about these market dynamics. She's not analyzing supply and demand curves. She's thinking about her grandchildren, about leaving them something real and valuable, something that can't be debased by government policy, something that holds value regardless of political chaos, economic uncertainty, or monetary experiments gone wrong. But her simple act of buying and holding 20 ounces, when multiplied by thousands of others doing the exact same thing, creates a force, a quiet revolution, a rejection of the paper paradigm that dominates modern finance. And that's the real news the bullion dealer wanted to share. Not price predictions, not chart patterns, not technical analysis, but transformation, a market evolving from speculation-driven to conviction-driven. Now, I want to address something directly because I know some of you watching are thinking about getting into silver, but you're not sure where to start. Should you buy physical? Should you buy mining stocks? Should you split between both? These are crucial questions, and the answers aren't one size fits all. Let me walk you through a scenario that plays out every single day in precious metals dealers across the country. Two men sit across a table from a dealer. Both of them believe in silver's future. Both have studied the fundamentals. Both see similar trends developing. But their investment strategies couldn't be more different. The first man pushes a stack of cash forward and says clearly, "Physical silver. I want coins and bars, something I can actually hold in my hands." The dealer nods, does the quick calculation. At current market prices, you'll get approximately 300 ounces for that amount. The man accepts this, 300 ounces of real metal that he'll take possession of. Safe, secure, certain. The second man leans back in his chair, looks at that same pile of cash, but his mind is working differently. He asks, "What about mining stocks? Something that gives me leverage to silver's price movements." The dealer smiles slightly because he knows this is a completely different game. Much higher risk, but also potentially much higher rewards. The second man nods. He understands he's not buying certainty. He's buying possibility. This conversation happens constantly. The eternal debate among silver investors. Physical versus equity ownership. Safety versus leverage. Possession versus exposure. And throughout 2025, as silver carved out its historic price path, this debate intensified dramatically. Here's the reality that most people don't fully grasp. Physical silver moves in direct correlation with the metal price. Silver up 10%, your stack is worth 10% more. Silver down 20%, your stack loses 20%. Direct one-to-one correlation. No surprises, no multipliers, but also no acceleration beyond the metal's price movement itself. Mining stocks operate on a completely different principle. They amplify, they magnify, they multiply price movements. When silver rises 10%, a well-positioned mining stock might surge 30%, 50%, sometimes even more. The leverage works beautifully on the way up, creating returns that make physical holders jealous. But here's what they conveniently leave out of the promotional materials and the YouTube videos pumping mining stocks. That exact same leverage works in brutal reverse. Silver drops 10%. That mining stock might crater 25%, 40%. Swift, merciless, gut-wrenching declines that shake out weak hands. Despite this extreme volatility and very real risks, One particular company kept appearing in conversations throughout the silver bull market. Argenta Silver, trading under ticker symbol AGF, available on platforms like Interactive Brokers and Charles Schwab, a pure silver play in a market where pure silver plays are increasingly rare. Let me tell you the story because it's actually fascinating. The story begins in Argentina, in Salta province, remote, rugged, mineral-rich territory. There's a project there called El Caver. The previous owners poured 60 million Canadian dollars into developing it, exploration work, infrastructure development. They built a camp capable of housing 100 workers. They drilled extensively. They made discoveries. And then they just walked away, abandoned the whole thing. September 2024, Argenta Silver stepped in and acquired the project. Purchase price? 3.5 million Canadian dollars. Read that again slowly. $60 million invested by the previous owners, sold for 3.5 million. That is a 94% discount on a project that was at the production stage, with established infrastructure and proven resources. When you see numbers like that, you have to ask yourself what you're missing. The resource numbers tell an interesting story. 45.3 million ounces of indicated silver resources at 482 grams per ton. An additional 4.1 million ounces inferred at 417 grams per ton. Nearly 50 million ounces total. But here's the detail that made analysts sit up and pay attention. Less than 1% of the total land package had been explored. Less than 1%, meaning 99% remained untested, undrilled, unknown. Potential waiting to be discovered. But numbers alone never move markets. People do. And two names attached to Argenta Silver carried significant weight in mining circles. Frank Giustra, a mining billionaire who's built multiple fortunes by recognizing value where others saw only risk. He increased his position in Argenta during the bull market. Not decreased, not maintained. Increased. During a time when smart money typically takes profits off the table, he added more. Eduardo Elstein, an Argentinian real estate entrepreneur with a proven track record. In May 2025, he invested millions into Argenta. Then, several months later, he invested millions more. 2 separate capital injections in the same calendar year. These weren't small diversification positions. These were conviction moves by people who understand mining, who recognize value, and who position for long-term success. Together, through various entities they control, Giustra and Elstein owned roughly 25% of Argenta Silver, a quarter of the entire company locked up in the hands of 2 individuals with proven track records. The market definitely noticed. Argenta's shares absolutely exploded, surging 188% during 2025, nearly tripling in value. But then came reality, volatility, the inevitable pullback that accompanies all speculative assets. From peak to present, the stock dropped 34%, giving back a third of its gains. This is the inherent nature of mining equity investments. Explosive upside potential, painful corrections, emotional whiplash that tests investor conviction. Yet underneath all that price volatility, the fundamental story remained intact. $18 million in working capital sitting in the bank. Drills actively turning right now in Argentina. Results coming in, data accumulating. And the company was operating in Argentina as top mining jurisdiction according to the Fraser Institute's 2023 rankings. The best rated location in all of Latin America. Political stability, regulatory clarity, infrastructure access, everything a mining company needs to operate successfully and potentially deliver substantial value. But here's where the story gets interesting and where you need to be completely honest with yourself about risk tolerance. The second man at the table, the one who chose leverage over possession, faces a completely different set of variables than the physical silver buyer. Physical silver has essentially one primary risk: price movement. Mining stocks have multiple layers of risk, management decisions that could be brilliant or disastrous, operational challenges at the mine site, jurisdictional changes in government policy, financing needs if capital runs low, geological surprises that can be positive or negative. Each variable adds complexity. Each complexity adds risk. And yet, for certain investors, the potential rewards justify accepting those risks. Not for all investors, not for most investors perhaps. But for some investors who understand that mining stocks are not savings vehicles. They're speculation, calculated, informed speculation if done properly, but speculation nonetheless. The woman with coins secured in her safe doesn't lose sleep worrying about management decisions at Argenta. She doesn't stress about drilling results. She doesn't track quarterly earnings reports. Her silver sits constant, unchanging, certain. The man who owns Argenta shares? He watches, he monitors, he evaluates continuously. His investment isn't passive, it's active, requiring attention, judgment, and timing. This distinction matters enormously, especially right now, especially as silver potentially enters what many analysts believe is the early phase of a historic long-term bull market. Because bull markets create options. They create choices, different pathways forward. Exchange-traded funds offer liquidity, buy and sell instantly like stocks, trade easily, but you own paper promises, not actual metal. Futures contracts offer leverage, control large positions with relatively small capital, but you face rollover costs every month, margin requirements that can wipe you out. Counterparty risk that people don't think about until it's too late. Mining stocks offer what we call operational leverage, the potential for your capital to multiply many times over as a company grows production. But you accept company-specific risks that have absolutely nothing to do with silver's price. Physical silver offers possession, control, certainty of ownership, but you sacrifice liquidity. You pay storage and insurance costs. You accept zero leverage on price movements. Each path has legitimate merit. Each path involves trade-offs. The question isn't which path is universally best. The question is which path aligns with your specific situation, your personal risk tolerance, your investment time horizon, and your ultimate financial goals. Because here's what the bullion dealer understood at a deep level. The new silver stackers flooding into the market weren't all identical. Some sought pure safety, some sought maximum gains, some sought both. And the sophisticated ones, the ones who really thought it through, they didn't choose one path exclusively. They allocated intelligently. Some physical silver for security and peace of mind, some mining equities for leverage and growth potential, some cash kept on the sidelines for opportunities during corrections. Diversification within diversification, a layered approach to an inherently uncertain future. Argenta Silver represented one piece of that larger puzzle for certain investors. Not the whole picture, not a guaranteed winner. One piece for those willing to accept mining equity risks in exchange for potential mining equity rewards. With $18 million in the bank, less than 1% of land explored, 2 billionaire-level backers increasing their positions, and silver itself in what might be a historic bull market, the setup was genuinely compelling, not guaranteed. Not without significant risks, but compelling enough to warrant serious consideration and proper due diligence. The dealer made this absolutely clear to everyone who asked about mining stocks. Do your own homework, he told them every single time. Research the company thoroughly, understand all the risks involved, never invest money you cannot afford to lose completely, because mining stocks aren't savings accounts. They're not emergency funds. They're speculation on operational success within a favorable commodity price environment. Two separate variables. Both must align for the investment to work. But for those who did their homework, who truly understood the risks, who positioned their portfolio appropriately, companies like Argenta offered something physical silver fundamentally cannot provide. Operational leverage, the potential for the company itself to grow resources substantially, to expand production significantly, to multiply shareholder value well beyond simple metal price appreciation. This is the leverage game. High risk, high potential reward. And in a silver bull market, many believe the game is just beginning. There's a moment that arrives in every bull market that separates the truly prepared from the merely hopeful. It's not the initial surge, not the excitement of watching profits pile up, not the feeling of being right. It's the correction, the pullback, the test of conviction. And for silver, that test is absolutely coming. It always does without exception. The year 2025 delivered something genuinely unprecedented in the silver market. Prices surged nearly 150%. Silver briefly touched $80 an ounce. It became, at least for a moment, the world's third largest performing asset class. Headlines absolutely everywhere. Mainstream financial media couldn't stop covering it. Retail excitement reached fever pitch, the perfect storm for both extraordinary opportunity and potential disaster. Because here's what market history teaches us repeatedly. Bull markets attract two very distinct types of participants. The first type sees a legitimate opportunity. They research thoroughly before buying. They plan their position sizing carefully. They understand exactly what they're purchasing and why. They prepare themselves mentally for extreme volatility. They expect corrections as normal market behavior. They hold through chaos and panic. These people build substantial wealth over time. The second type sees what looks like a lottery ticket. They chase price momentum. They succumb to fear of missing out. They buy at market tops. They panic at the first sign of trouble. They sell at market bottoms. These people provide exit liquidity and profits to the first group. The dealer's news about hundreds of new silver stackers entering the market contained both groups mixed together, indistinguishable at first glance. But time always reveals who belongs to which group. Time and volatility never fail to separate them. Summit Metals and other dealers reported hundreds of new customer accounts, small purchases, first-time buyers. But statistics alone don't tell the complete story. Some of those buyers had researched silver for months before making their first purchase. They'd read books about monetary history. They'd watched educational content. They understood inflation's destructive effects. They understood monetary policy implications. They understood silver's historical role as insurance against currency debasement. Other buyers saw a viral TikTok video, heard silver was going to the moon, threw money at the first dealer they could find online, expected quick riches with no downside risk, same action on the surface, buying silver, but completely different underlying motivations, which means completely different outcomes waiting just ahead. This is precisely why education matters so critically, why preparation matters, why understanding what you own matters more than any other factor. Because silver is not like stocks or real estate or cryptocurrency. Silver is volatile in ways that shock unprepared investors. From $80, silver could absolutely drop to $50, to $40, even to $35. Not because the fundamental story changed, not because anything broke, simply because markets correct, always, without exception. No bull market moves in a straight line upward forever. And when that correction inevitably arrives, the unprepared will panic, they'll sell in fear, they'll swear off silver forever, they'll tell everyone who will listen that they lost money in silver and it's a scam. Meanwhile, the prepared will do something entirely different. They'll buy more, because they understand that volatility isn't a flaw in silver. It's an inherent feature. It's normal. It's expected. It's an opportunity if you're positioned correctly. Physical silver serves one primary purpose that you must understand clearly. Wealth preservation, not wealth creation, not speculation, not getting rich quick. Preservation of what you've already built through years of hard work. It's the difference between a life jacket and a speedboat. The life jacket keeps you floating safely. It doesn't make you wealthy. It doesn't provide thrills. It doesn't impress anyone at parties. But when the storm hits, when the ship starts taking on water, when chaos erupts all around, that boring, simple life jacket becomes absolutely priceless. Silver is your financial life jacket. In a financial system constructed on ever-growing mountains of debt, in a monetary system based entirely on unlimited printing, in an economy that depends on continuous inflation to function, silver sits there, unchanging, uncompromising, unprintable, a tangible asset in an increasingly intangible world where most wealth exists only as numbers in computer databases. The Federal Reserve's stated 2% inflation target sounds harmless enough, manageable, responsible even. But compound it mathematically over decades. Your purchasing power gets cut in half every 36 years by intentional design. This isn't conspiracy theory or fear-mongering. It's openly stated policy written clearly in their documents, repeated in official speeches, accepted as normal and necessary by mainstream economists. But it's not normal. It's legalized theft. Slow, systematic, socially accepted theft of your purchasing power. And silver represents your opt-out, your exit from that system. When you hold physical silver in your possession, you're making a statement. Not political, not social, purely financial. You're saying, I refuse to participate in my own gradual impoverishment. I reject automatic debasement. I choose sound money that cannot be printed. It's a quiet rebellion, a personal declaration, an act of financial independence that requires no one's permission. But this rebellion, this strategy, requires something most modern investors completely lack: discipline, patience, long-term thinking. Because silver will not make you rich overnight. It won't double your money in a week. It won't generate passive income you can live on. It will sit in your safe year after year, decade after decade, quietly maintaining value, steadily preserving wealth, reliably protecting purchasing power. That's it. That's the entire value proposition. And for many people, that's not nearly exciting enough. They want action. They want returns they can brag about. They want exponential growth. That's where the leverage plays enter the picture. The mining stocks, the futures contracts, the call options. These financial instruments offer what physical silver fundamentally doesn't: potential for dramatic acceleration of returns. Argenta Silver surged 188% during the bull run. That's acceleration. That's leverage, working in your favor. But then it dropped 34%. That's the price you pay for acceleration. That's leverage working against you. Both come together as a package. You cannot have one without accepting the other. The sophisticated approach combines both strategies intelligently. Physical silver as your foundation, as your insurance policy, as your life jacket, a percentage you never touch, never trade, never sell regardless of what's happening in markets. Mining equities as speculation, as your leverage play, as calculated risk-taking with capital you can afford to lose. A percentage you actively manage, watch carefully, and adjust as market conditions evolve. This combination allows you to preserve wealth while simultaneously pursuing growth, to stay safe while taking calculated risks, to sleep soundly at night while betting on the future. But here's the absolutely critical point that cannot be emphasized enough. The order matters tremendously. Physical silver first, speculation second. Not the other way around, never the other way around. Too many new silver buyers make this fundamental mistake. They jump straight into mining stocks. They skip building any foundation. They chase the excitement and the potential for quick gains. And when the inevitable correction arrives, they have nothing to fall back on. No physical silver cushion, no preserved wealth base, just losses and regret and another cautionary tale. The woman with coins, secured in her safe, built her foundation first. She knows exactly how many ounces she owns. She doesn't check silver prices daily. She doesn't panic during corrections because her silver isn't an investment she's trying to trade. It's insurance, protection, a safety net. And you don't sell your insurance policy when you need it most. Now, that same woman might also own shares of Argenta. She might trade silver ETFs occasionally. She might even speculate on futures if she understands them. But all of that comes after she built her foundation, not before. Foundation first, speculation second. This is the critical framework that new silver stackers desperately need to understand. This is the education the dealer was concerned about. Because without this framework, without this understanding, history will simply repeat itself yet again. New buyers will panic during the first major correction. They'll sell at the absolute worst possible moment. They'll reinforce every negative stereotype about retail investors being weak hands and dumb money. They'll become cautionary tales that get repeated for years. But with proper education, with realistic expectations clearly set up front, with correct position sizing and proper strategy, they'll become something entirely different. They'll become the distributed ownership base, the strong hands, the foundation of silver's next major phase. 25% of all silver exists as physical coins, rounds, and bars. That percentage seems small in the big picture, but it's growing. With every new stacker, with every small purchase, with every ounce tucked securely into a safe or a drawer, the available supply shrinks in real terms. Meanwhile, industrial users still need massive quantities of silver for manufacturing. Technology companies still consume enormous amounts for electronics, solar panels, electric vehicles. But now there's progressively less available to meet that demand because more and more silver sits in private hands, strong hands that have zero plans to let go. This is the structural change happening beneath the surface, the transformation that doesn't show up clearly on price charts. It's not about price, it's about ownership, about distribution, about conviction. From traders to holders, from speculators to preservers, from paper contracts to physical possession. The dealer's phone call revealed this shift in its early stages. Hundreds of new accounts at Summit Metals, thousands more across the entire industry, small purchases, first-time buyers, people taking their first step into physical silver ownership. But if they stay in the market, if they hold through inevitable volatility, if they truly understand what they own and why they own it, they become something powerful. They become the new foundation upon which everything else rests. And foundations matter enormously, because above any foundation, everything else gets built. The paper, contracts, the ETF shares, the mining stocks, the futures markets, all of it depends ultimately on physical reality, on actual metal that exists in the real world, on tangible supply that can be measured and verified. And when that supply increasingly sits in hands that won't sell except under extraordinary circumstances, the fundamental dynamics shift, not overnight in an obvious way, but inevitably over time. Silver's exact price path from here forward is completely uncertain. Nobody knows. Nobody can know with certainty. It might surge to $100 in the next rally. It might correct back down to $45 first. It might trade sideways for 2 years, testing everyone's patience. Predictions are worthless. But what we do know with certainty is that the underlying fundamentals remain firmly in place. Deficit spending by governments continues accelerating. Money printing persists as the go-to solution for every problem. Inflation quietly erodes purchasing power year after year. Debt accumulates to levels that can never realistically be repaid. Trust in institutions and currencies diminishes progressively. And in that environment, in that world, physical assets hold their relevance, particularly monetary metals like silver and gold that have maintained value across thousands of years of human history. The woman with her coins doesn't care if silver hits $100 next month or next year. She's not selling, she's not trading, she's not trying to time tops and bottoms. She's preserving wealth for her grandchildren, for unexpected emergencies that might arise, for the uncertain future we all face together. That's the mentality, that's the framework, that's the transformation the dealer witnessed firsthand. So when you hear news about thousands of new silver stackers entering the market, don't immediately think about price targets. Don't obsess over whether we've hit the top. Think about foundations. Think about distributed ownership spreading silver across thousands of individual households. Think about quiet revolution happening away from cameras and headlines. Because that's what's actually unfolding right now. Not on CNBC, not in mainstream financial media, but in homes across America and around the world. In safes being filled 1 ounce at a time. In private decisions being made by regular people who see trouble ahead and want protection. Repeated thousands and thousands of times. That's the real news. That's the genuine story. That's what actually matters most in the long run. Markets will do what markets always do. Surge higher. correct violently, consolidate, then repeat the cycle. But underneath all that short-term noise and volatility, a foundation is being built, one modest purchase at a time, one new stacker at a time, 1 ounce at a time, and that foundation will outlast every bull market, every correction, every crisis, every panic, because it's not built on speculation or hype or promises of easy wealth. It's built on something far more durable, understanding, preparation, and the simple recognition that in an increasingly uncertain world, having something real, something tangible, something you directly control matters more than almost anything else. This is the transformation taking place. This is the news worth sharing. This is what the dealer wanted people to understand. Not price predictions that will be wrong, not trading strategies that work until they don't, but genuine hope. Hope that more people are finally taking real responsibility for their financial future. Hope that more people are educating themselves about money and monetary history. Hope that more people are positioning themselves and their families for whatever challenges lie ahead, with silver in hand, ready, prepared, empowered to weather whatever storms may come. That's the best news anyone could possibly receive in today's world. And that's exactly why you need to be part of this community. Before you go, make sure you've subscribed to Money Aftermath. Hit that notification bell so you never miss an update. Share this video with someone who needs this message. Drop a comment below with your thoughts. And remember, we're building something important here. A community of people who think differently about money, who prepare instead of panic, who build wealth that lasts instead of chasing quick profits that evaporate. I will see you in the next video where we'll continue this crucial conversation about protecting your financial future. Until then, stay informed, stay prepared, and keep building your foundation.